We've been saying this for the last 18 months, that we are in a rolling recession. It started 18 months ago with 2 consecutive negative quarters for real GDP growth at an annualized rate. And since then, one sector after another has stumbled. So housing, for example. Housing, by many metrics, is down 40 to 50% on a year-over-year basis. That is a recession. In fact, it's worse than a recession. We've gone back to COVID lows. We're not far from 08, 09 lows. And remember, the housing crisis is what started that global crisis off.
Former Speaker Nancy Pelosi, on Friday, refuted the suggestion that she had broken a promise to Representative Kevin McCarthy when he was removed from his role during this week's historic vote. Pelosi pointed to several concerns raised by Democrats that led to McCarthy's removal, including the Republican impeachment inquiry into President Biden. She emphasized, "If you don't respect the institution, then don't expect us to bail you out." This vote marked the first time the House had ever removed a speaker from their leadership position, with a 216-2 vote in which Republicans, led by Representative Matt Gaetz, joined Democrats. According to Cathie Wood, the removal of the speaker has resulted in a government gridlock, and the U.S. government faces the risk of a complete shutdown amid an impending severe recession. In this video, Cathie Wood discusses the government gridlock and the implications of fiscal and monetary policy on the current economic situation.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We now have government gridlock. What happened with the House Speaker being ousted suggests that the government could shut down in the next 6 weeks. So I know there's a lot of nervousness around government spending, which up to now has been a stimulant. We think the next year, election year, is going to be more along the lines of gridlock. Inventories, if we listen to our companies and to other companies that we don't own but monitor for their cyclical indications, many are saying that inventories are dropping. They're dropping dramatically at the retail level. And yet we don't see that in the overall economic statistics. In fact, the revision to real GDP in the second quarter showed inventories flipping from negative back to positive. So we haven't seen a broad-based inventory decline yet. And we do think that is coming. One of the ways we're seeing it is in the trade sector. So our imports are dropping, I believe, a double-digit rate. And that is something I'll come back to because I don't think economists and investors spend enough time understanding what is happening in the rest of the world. And we think the rest of the world is experiencing much more pain than we are. Certainly China, increasingly Europe, and of course, they influence the rest of the world. This is the federal budget deficit as a percent of nominal GDP. And as you can see, we're in the 7.5% to 8% deficit range relative to GDP. So if you look at this in the context of history, I remember when I first got into the business and in the early 80s, we were running a deficit north of 5%. That was because we had back-to-back recessions. You can see those shaded lines there are recessions. And the government was doing what it typically does, trying to become a buffer against the hardship caused by recessions. So we got to 5.6% deficit as a share of GDP. And I remember the ruckus being raised there. And one of the answers to curing that deficit was growth. So tax cuts, regulations being cut, tariffs being cut, and real growth being stimulated. And we do think that that will proved to be the case again. Now, you can see what happened during COVID and during the great financial crisis. Our government threw everything it had at both of these crises. And you can see we've come back, but, in the absence of a full-blown recession, 7.5%, 8%, very high by historical standards. And some would say that it is quite discouraging. And I'll come back to the notion that perhaps we are in this rolling recession. Those who think we're not in a recession can look aghast at this number, but it would suggest that we could be in a recession, and there are some contracyclical spending measures taking place in addition to the stimulus coming out of COVID, the COVID crisis, and the so-called Inflation Reduction Act.
In this video, Cathie Wood frequently discusses inventories, and you might be curious about what exactly they are. Inventories refer to goods held by organizations for the purpose of sale or distribution. A well-known example of an inventory is strategic oil reserves, which are substantial stockpiles of crude oil maintained by governments for emergency purposes. These reserves play a critical role in ensuring energy security, stabilizing oil prices, and providing geopolitical leverage. Typically, they are stored in underground salt caverns or tanks, with decisions regarding their release made at the highest governmental levels. While these reserves act as a safety net against supply disruptions and price fluctuations, establishing and maintaining them comes at a significant cost, and their release can have a notable impact on global market dynamics. Prominent examples include the U.S. Strategic Petroleum Reserve and China's rapidly expanding stockpiles. Cathie Wood now delves into monetary policy, delving into aspects such as money supply and the impact of OPEC oil cuts. Let's hear what insights she has to offer on these matters.
M2 growth being negative on a year-over-year basis. This is percentage decline. And you can see it's in the minus 3.5% to 4% range. You haven't seen this. You don't see it on this chart. You'd have to take this chart back into the 1930s to see it. Now, the other side of this is we had that burst of money growth up to 27% during COVID. Again, the Fed throwing everything they had at it. And so this is a natural reversal. But this is more now than a year-long decline. So now we think it is starting to bite. And if velocity drops, and you've heard me talk about velocity before, the rate at which money turns over, then this will exacerbate the downturn that we expect. Now, we can already tell that velocity is starting to diminish. It was growing very rapidly to get back to trend after COVID, but it never got back to trend, and it is slipping again. And maybe next time I'll put that chart in. But we know the housing sector is stuck. And that is often, the movement in the housing stock often unlocks a lot of equity and increases the velocity of money. That is not happening. So we are concerned that money growth is still negative, and we do worry that velocity will fall and compound the impact of this year-over-year decline. Now, here is the long-term perspective on the 10-year Treasury yield. And you can see history going back into the 1800s. Now, the Fed came into existence in 1913, so you can eyeball it there. And if you look at the chart before that, we rarely went above 5% interest rates. And you can see what happened afterwards. Especially after 1971, when we closed the gold window and monetary policy became unhinged. The Fed effectively accommodated the quadrupling of oil prices that OPEC put through right after that. And you can see what a disaster that was throughout the 70s and into the early 80s. And then in the early 80s, again, we had really good fiscal and monetary policy, fiscal policy encouraging growth, monetary policy, Chairman Volcker just saying, we are not accommodating these price increases. But money growth never went negative. In fact, I will show you back there. If you look in the 80s, you'll see in the early 80s, money growth was in the high single-digit range. It never went negative. And inflation and interest rates came down. And we went into a 40-year bull market in bonds. Now, what has happened since the low in interest rates in 2020 is we have had the worst bear market, I think, ever. And interest rates were at such a low level that it didn't take much of an increase to cause outright losses in bonds. And if you look at what has happened and tally it up, if you use the 10-year Treasury bond, I think the losses in terms of principal have been something like 45%. If you use the 30-year, it's more like it's more than 50%. So those are the sorts of declines we saw in the stock market after the tech and telecom bust, and then in the global financial crisis in 08, 09. It doesn't look like it's severe, but it's just the low rate from which it started. And this is also an incredible problem for banks right now. They have a lot of assets on their books with very low yields. They piled into treasury assets during COVID thinking that interest rates certainly wouldn't go up for years and years and years. And you can see they hadn't gone up in years.
The Organization of the Petroleum Exporting Countries, OPEC, and its allies have restated their dedication to ongoing production cuts of at least 1.3 million barrels per day. This commitment comes as crude oil prices experienced a nearly 6% drop on Wednesday, marking the most significant one-day sell-off since September 2022. This notable weakness in oil prices has raised concerns, causing them to dip below $80 and casting doubt on the feasibility of reaching the $100 price level. Furthermore, OPEC has opted to maintain its oil production policy, a decision that was widely expected. Their next meeting is not scheduled until November 26. West Texas Intermediate crude, traded in New York for November delivery, saw a nearly 6% decline, settling at $84.22 a barrel. U.S. benchmark crude prices previously hit a one-month low of $84.07 and experienced a 7% decrease over the week. Several factors contributed to this sharp decline, including a seasonal drop in U.S. demand, which seemed to catch those banking on a near-future oil price rally by surprise. The International Energy Agency's August 2023 report noted that global oil demand has reached record levels and is anticipated to rise further this year. However, the rapid adoption of electric vehicles, renewable energy sources, and reduced dependence on Russian gas are projected to lead to a peak in crude oil demand before the decade's end. As economic concerns arise due to rising interest rates and overseas supply, some analysts anticipate that OPEC may need to reduce output even more than initially planned to stabilize prices. Saudi Arabia and Russia, the world's largest crude oil suppliers, have both affirmed their commitment to the joint plan to continue cutting at least 1.3 million barrels per day from their daily production until the year's end. We invite you to share your thoughts on Cathie Wood's analysis in the comments section below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.